Okay, today I'm going to talk about mortgage, extra payments. This is a environment of high interest rates for mortgages, and maybe your mortgage is renewing and it's going to be a high interest rate, or if you have an existing high interest rate on your mortgage, you might be asking the question, uh, is there a better way of paying it down than just directly paying extra money to the mortgage itself? So let's have a look at that situation here. We're going to bring you up to this other screen, and it's going to be this right here, and I'm going to bring that screen up, and you can see right here that we have some different vignettes that we can look at. So let's have a look at this. We've got a scenario here, and we're going to pretend that we've got a $400,000 mortgage, and let's give it a rate of 5%, high mortgage rate, relatively compared to what it has been. We got the fair market value of the house. It's going to be, we're going to keep it at 500,000. We're not going to increase the value of that because we'll take that out of the equation. That's just going to complicate matters. Let's look at a 25-year mortgage. That's 300 months. And here we've got this extra $1,000 that we don't know where to allocate that. Should we pay down the mortgage directly? Should we put it into an account, a safe account, let's say? There's certain tax exempt accounts under the Income Tax Act that we can look at that are paying competitive rates. Or should we put it into, let's say, an investment, a vehicle? Let's have a look and see what works best. So we got this $400,000 mortgage. Okay, so now we're going to allocate this to the loan itself, to the mortgage. And if we start, bringing that down, we can see, okay, we're putting 33.38 into the mortgage every month. The mortgage rate itself was 23.38, but with the extra $1,000, you can see that it's adding to it and paying it down faster. But how fast is it going to pay it down? Let's see when that freedom point is. There it is at month 167. Okay, well, that saves 133 months. That's 14 years instead of 25 years. So yes, you've knocked off a lot of years of that mortgage. And so there you go. And if we play that down to the end, you can see that you've got no control of that extra $1,000 over those years. The extra payments did not increase the value of the house because we took that out of the equation. The potential asset values resulting from the extra payment, zero. Okay, let's bring this back. Now let's look at another scenario. If we take that $1,000, do we necessarily have to put it down against the mortgage to pay that down? Or what if we could earn 5% on that mortgage? Same interest rate as what you're paying. Now let's have a look. Okay, we are going to slide this forward. And now you can see that $1,000 is going directly to the savings. And so now you've got $1,000. Hey, after a number of months, a couple of years, actually, you've got $41,000 that you have control over. And yes, you're paying down your mortgage slowly, but if we bring this forward, let's have a look at this very important point right here. Okay, so we've got a break-even point right about this point here. And you can see that this last payment for $1,000 is going into here. And if we bring this forward just another month or so, you can see, okay, no more money. We've got more money in the savings tank than we do in the mortgage itself. So we could actually pay that mortgage off, no question, and still have, $8,000 or $9,000 left over that we've saved. So that freedom point, it's the same number of months. It's not any sooner, but look at the control that we've had over those months. And now if we just continue to let that compound, we're not going to put another dime in that. What will that end up accumulating to at the end of year 25? And you can see that here it is. We've got an extra $418,000 now that has accumulated to. Yeah. And so if you can see here that all those extra payments, they're not going to increase the value of the house. That's why we took that out of the equation. So we can skip this part here. But the potential difference between putting the extra on the loan or in the safe tank is $418,000. Interesting. Let's look back here and let's look at the risk, putting that money into something that pays 8%. Okay, so now the $1,000 that's going into this risk tank here, we're going to hit a break-even point here, and it's very hard to kind of match that. Okay, we've exceeded the break-even point, but here it is over here. we've got 151 months. So that's 15 months sooner than paying off the mortgage directly, putting that $1,000 into the mortgage directly. So yes, we've increased our freedom on that. And if we advance this forward, you can see that we've got a pretty major difference here. We've got 151 months of control over the payment, plus the tank value that we've had all along. In other words, we still have access to this money. The extra payments did not increase the value of the house. And let's see, so we'll skip over that. And the potential difference is $740,000. Okay, so let me just stop this share for a moment and bring this up. And let's talk about this for a second. See, the extra $1,000 into that tank, it doesn't earn any interest when you're paying it directly into the mortgage. You've lost control of that $1,000 as well. And so the question is, where's the best place to allocate those dollars given these high interest rates? So, get a hold of us. We take different people through different scenarios that they might have. They have questions. How do they handle this? Is there a better way? And helps people make an informed decision. So get a hold of us. It's Infinite Banking Canada Group, ibcanadagroup.ca or ibcanadagroup.com. And we hope to hear from you. Hopefully we can help you answer some questions, make some informed decisions.